Hello everybody, Greg here at Master Trader. I've been doing videos recently and posting them in responses to questions from students about trades that they're taking or focusing on. And so this one is from a student that trades Forex. Our approach, method, Master Trader technical strategies can be applied to anything. Chart's a chart as we see it. Doesn't matter whether it's a currency pair, a commodity, a stock, an index, it doesn't matter. So the question was about these trades that they looked at that they actually passed on. And this is the pound Australian dollar. And so it was a breakdown. This had an hourly chart. Their primary time frame, meaning this is the time frame they're going to trade from, is the hourly time frame, and then pointing out it was a bearish wide range bar, negative WRB, price reversal with a bottoming tail bar. Green bar ignored. These are all terminology from the MTS course with a swing trading course, and then it went sideways, setting up a breakdown trade. And a daily chart, which could be, in this, since I'm inferring from what they're saying, the daily chart is where they're going to get their bias, which makes sense. Higher time frame bias, primary time frame where you're trading from. And then on the daily chart, prices are at minor support and congestion to the left of an uptrend. Here is the daily chart. It's congesting here. There's some sideways price movement there. So, and I'll go through my review of what I see on these time frames. And so they marked up the chart post-trade. I'm not sure they made the right decision in real time. What's your analysis? Okay, so they have a multiple time frames here, which I would suggest get rid of the 5-minute chart, get rid of the 15-minute chart, get rid of the weekly chart. The less information you're looking at, the easier it's going to be to make a decision. Now, the fear for everyone is, oh, I'm going to miss out on something in another time frame. Well, that's the way things are. The more you look at, the more confusing it can become. So now you're going to stick to what I would refer to as being what's your world, the time frames that you choose from. Take the good and the bad and the ugly when if it happens. So on the daily time frame, this middle chart here, gathering a bias, you see that this wasn't an uptrend and it tops out. And top out doesn't mean it's going to go down. Looking further at what happens here in September, it breaks out, and then he's got failed breakout, FBO. So that provides a bias now that sellers are taking control because it had pulled back into the congestion and it attempts to go up. Everything's based on supply and demand. It came into a demand area, support. Buyers stepped up. It broke out, relatively wide range bar, and it fails. It comes right back in again and it starts going sideways. So that's we call it an upside shakeout or a failed breakout. And then it starts going sideways. Now it already tested the support and the breakout failed. At that point, I'm giving that less weight as a bias, as that support is going to hold in the future. Now, as it goes sideways over here, it's got 2x NBR at resistance, narrow range bar at resistance. So at that point, it breaks down under the support. So by the time it breaks down, by then you have already needed to have made a decision as to what you're doing here. But what we're gaining from this daily chart is I got a bias that it topped out. It had a breakout failure. I think it's going to go lower. All right, so now we go to the hourly chart. That's a choice, hourly chart. You live with that. And then what happens there, he's got the minus wide range bar breakdown. So it does break down. Now, can you short it under the wide range bar? Yes. You can short it under the wide range bar with a stop above the high of the wide range bar. Now, I don't trade Forex. I don't even look at this currency pair. I don't know what the value is of a pip. I don't know. So in other words, I don't know what the dollar risk is of putting a stop loss up there and entering under the wide range bar. But whatever acceptable to you, that's where the stop would be. And then you see what happens. Now, at that point, you're sitting with this for hours. Now, where he has the topping tail minus 180, it retraced right back up into the breakdown area. You know there are going to be sellers there. But at that point, you have a choice. Do you sell it short at the top of the wide range bar, that would appear to be a bad decision. At the moment, you don't know it's going to go down, but you know there's going to be sellers there. So at that point, you're waiting for this to come back down again, confirmation. Now, if you decided to look at the 15-minute or the 5-minute, looking at expecting that there's going to be a turn up there at that resistance, that's a decision if you're going to start looking at smaller time frames, but that's where it starts to become more confusing. What I'm pointing out here on the hourly chart is to just think that there are going to be sellers there and then wait and see if they're able to take control. So there's a lot of waiting here. And in this particular example, it doesn't mean it's always that way. And so after it starts going sideways and it doesn't go up, at that point you have the idea of being able to sell a breakdown trade. And that's where he said -123. There was a news event on the 123. He's got the red circle there. That could have been a trigger. Stop's going to have to be above the red breakdown bar if you didn't sell the breakdown. And then from there, manage it however you're going to manage it from the hourly chart, or take your money. Of course, look to the left. It looks like something like this could go down more. You have to manage it from there. Now, I'm going to go to my charts and show, but the other one that he showed was CAD, CFH. Again, this 5-minute is so erratic at the current time frame. He's showing it to me, but I see it was so tight. Looking here, it's got 12 o'clock, 1 o'clock, 2 o'clock, 3 o'clock. And see how tight the bars were and how small they were? Which makes me think there's probably better times of the day or night to be trading these things where they're more liquid. But for whatever event, when we see small bars like that, it was quiet. And there's more certainty, and it's more predictable as to calling the direction at that point versus these wide whippy bars. Now, you don't know it's going to get wide and whippy unless you're thinking, hey, there's some news events that are going to be coming out at that point in time. Things maybe are not as liquid. I don't know. I just see this erratic price action and think I would have no desire to even be looking at this to consider any kind of a trade. But let's go to what he's saying is the primary time frame and the prime frame to get a bias from. And what we see on the daily chart is a bottoming pattern. And it's got marked bottoming tail bars, 1, 2, 3s. The plus 180, which is a red bar followed by a green bar, you got to put that in the context of a trend. But at that point, we see a big rounding bottom, and it looks like it can go up. So you're getting a bias. You go to your hourly time frame, find a setup that you could trade. A breakout, bottoming tail bar, pullback to support. Here's a 1, 2, 3 up here that's marked. So the bias here is to determine what time frame it is that you're going to create that bias from. The daily chart, I believe, is going to go up. Okay, forget the daily chart at that point. That bias that it's going to go up, of course, up to where? We look for price voids. There's a lack of resistance. Now he says, would this pivot be of concern for the 1, 2, 3, which is further down? No. The only time you get concerns of a prior pivot to the left is once prices reach it. Once prices reach that area, our expectation is that there's going to be sellers there. Then we wait to see what's going to happen. But our bias, where we're looking to get long, should be down near support, and this had a big rounding bottom. Now, on the hourly time frame, you look for your setups, and again, the best setup I saw here was on the hourly time frame at around 12 o'clock. There was that 1, 2, 3. Now, how you manage these, they're so volatile. I don't even want to think about managing it, but anyway, it's just so whippy and erratic. Just very difficult to, I can imagine, trying to trade this. So the British pound here, we went over the daily chart, and that had broken down. And so when you see here, like this green bar, this bottoming tail bar, which obviously says it's going to go up. Once it broke down as it did here, our thought process, that we learn from Master Trader Technical Strategies is that with a bearish bias, green bars should be ignored. So once I've got my bias, I'm over here on the hourly time frame looking for trades. So here was that breakdown that I showed you on the document that he had said that broke down, and now we're looking for an entry point. And this is pretty erratic type of price action, but again, our bias is going to go lower. This green bar ideally should be ignored. This becomes a pivot after 3 bars to the right. You say, well, it should break down. And that could have been your entry point with a stop up here. Again, you have to determine how many pips that is and what the, per how many contracts. Is it a micro trade? Is it a mini? Whatever you're trading. This is an obvious 1, 2, 3 type of a pattern where you short it under the green bars low. So once you learn these patterns and you have a bias, you just have to trade the setup as you know what it is in that time frame. And the money management is the key to being able to do that with all the other time frames and getting kind of crazy about it. All right, CAD Swiss franc was the other one. Bottoming pattern here. The wide range bar up, it pulls back to support. And here, this reversal, this 3-bar reversal, and this 1, 2, 3, that's your trigger long. Now, part of the thought process that we teach is that what's your first reference point of support? It's the prior bar's low. And you just, you keep doing that as the trend develops in that time frame. Does it violate a prior bar's low? In addition, how much does it retrace into a prior bar? Ideally, it's not going to retrace more than, ideally halfway into a prior bar, say a 50% retracement, nothing to do with fibs. It's just a generalization that most strong trends don't retrace or close more than 50% into a prior green bar. And so we see bar by bar keeps going up. And now you've got this range expansion bar as it comes into that prior pivot. Odds are this trend or this move is done short term. On the hourly time frame, you got to find your setup. You got to find your bias. So here's another 1, 2, 3. I don't know if this is a bad tick or whether that's a real bar that it retraced like that. If there's news events that are coming, you need to know those news events are coming that could cause such volatile price action, and it took out the low. So through that rather lengthy explanation, the takeaway here is to choose your bias time frame. You create a belief as to the reasons why you believe something's going to go up or down, and up or down to where. And then you go to your other time frame and find a recognizable pattern that you can trade and calculate your money management and position management and deal with it. If you choose to trade these type of instruments, you got to know what you're dealing with and know that they can have this kind of crazy price action. You need to know when these countries are reporting economic reports to be aware that you can get these kind of wild moves. And then technically, as I explained, bar by bar analysis, prior bars, highs and lows and pivots all come into how you're going to decide to manage that trade. So I hope that helps. As always, if you have any questions, email me, Greg at Master Trader.